Wayne, how are you doing, sir?
Great. Thanks, Matt. It's a fine time to be in the uranium industry.
Finally, right, right. So here we are. Everyone's super, super excited and stoked, and we're having a fantastic week. We're doing Uranium Uncovered, partly for people who've never invested in this space before, partly as a reminder to some of us who perhaps take some of these things for granted, and maybe a little bit of an explanation along the way as to maybe what certain things mean. So look, appreciate you calling in from North America, and perhaps that's the perspective that I would appreciate, because we've been talking to people in Australia, across Europe, in Africa, Canada, and now down the US with you. Let's talk about price first of all. Did you expect it to kind of rip through 100 as easily as it did?
Yeah, well, it was maybe just 2 weeks ago we talked and did a good company interview, and at that time I think we were $94, and I said, we're gonna hit 100, sooner or later. It won't be too long. I didn't know it was going to be 3 days later, and probably before the interview even published. So that was fun for me, and and my words then, with a longer term view of or at least a 2024 view of the market was, this is the year we're going to break an all time high. I may not stay there for a very long time, but I think that we have every chance to go, above $140, or, to that level, maybe $150. It's well within sight. And it was not if, but when, and I thought it would be 2024. So this is a time that the market has demand. We're going to be, seeing utilities in the market doing some more longer term contracting, but I'll say right now it's not very active in the long term market, and all the actions on the spot side. So but that's helpful, because the long term market pricing cannot stay this far apart from the spot price.
We'll come back to
Period.
that. I just want to talk about pricing and the sustainability of it. Okay. If I'm an investor, I want this thing to rip through 200. I'm super, super excited, because my assumption is that will reflect in share price appreciation, and I'm in the money. I'm ready to retire. Okay. If I'm a banker, if it's above $100, and for some sustained period, I'm still very, very comfortable with the economics for most advanced development stories that I've been looking at. So do we need it to stay higher than a 140, 150, the numbers that you mentioned, for long periods of time, or is 100 not too bad?
A hundred's well within in my view, the incentive price for producers. And you see more and more announcements about production being brought back online. You got the brownfields projects. You got some new producers aspiring to come on, but let's keep in mind that's a lengthy process, and it's quite a bit of time before product gets to market. So for 2024 and well into 2025, I don't see anything outside of some black swan event that would have downward pressure on the price. We have a deficit of supply. When buyers come to the spot market responds with significant, price signals towards the upside. This is a very favorable market. Supply is not just going to appear out of nowhere. So, but demand is certainly going to be strong and continuing. If we have the funds that purchase uranium and inventory, and it's a play on the price of uranium, active in the market, those guys come into the market and they're active. That's going to be continued upward pressure on the price, because nobody that I know of is sitting on surplus inventory. Even at $100, we don't have significant amounts of inventory coming into the market.
Well, if I'm looking at the US utilities, obviously they sit on inventory for their own purposes, not for resale, obviously. So if I'm looking at that, we used to talk about, they usually sit on about 3 years worth of inventory. That suggests that there's a little bit of time for some of the advanced players to, maybe get into production and kind of sell into that demand. Is it at 3 years still in the US?
Well, I think it's closer to 2 years. There was a there was a movement, quite a while ago, a couple of years back to, improve the economies and do just in time. And the U.S. utilities moved quite far towards a 2-year inventory. That being said, that they still sit on that. I don't anticipate utilities driving the spot price in 2024. They just simply don't. They're good planners. They should be. They got a serious job, the fuel buyers with the utilities, and they make sure that they're covered. They might come into the spot market if they see it as opportune, but today, the better pricing structure is actually in the term market. So more and more you'll see utilities coming in as term players, looking for to lock in what is presently a lower term price than a spot price.
Right. But there aren't that many companies they can sign term contracts with. We've seen, Cameco. We've seen Cameco and Kazatomprom. Sorry, he said, "Well, we're going to have a few problems on hitting our guidance, right?" Then you've got, most of the Kazatomprom stuff's heading east, it seems anyway. But then you've got only a small, I think possibly a handful of companies talking about new production anytime soon, maybe in the next 3 years. You're one of them. But, for frank and honest, if dollar terms very attractive, but in pounds, not too big. So the utility is going to be surely a little bit nervous about where they look for this stuff, because it's all been kind of mopped up. Spur's doing its thing, Yellowcake's doing its thing, and others. So if I'm a utility buyer now, do I start to think about contracting at near spot prices anytime soon, or do I, steel my nerves and hope it all goes away?
Good question. So the first aspect of that is really, how are the utilities looking at the up and coming producers, that the guys who haven't been in production, haven't been the stalwarts of the industry, supplied, and very clearly, there's a move towards contracting with the up and coming producers. More and more you see folks who have production ambitions announcing sales contracts. Their first sale contract, Peninsula has multiple ones. We've been in this game for quite a long time, but we got our first sales contract and it represents 200,000 pounds a year. That's what a utility is going to do with an up and coming producer. They don't put a big bet on them, but they're willing to put a bet on them. The up and coming producers then will layer in multiple 250,000 pound a year contracts to get to 1 million. And so many of the producers are talking about producing multiple millions of pounds a year. So, the contract book is going to be a small bit of their production in the future if they're successful. Otherwise, it's going to take quite a bit of effort. One contract does not a company make if you're a junior producer. Now, the second part of that, pricing and the guess on how does a utility take a bet in the U.S. particularly, but I think really globally, the Western utilities, the favored pricing structures these days tend to be hybrid. It's a portion of the contract is exposed to spot prices, and a portion of it is going to have a base price escalated. Now, typically, the spot portion is going to have floors and ceilings, and the floors and ceilings have certainly gone up in recent weeks and months. But the base price escalated, which is what you see the term price reported as. The term price is kind of the base price that you start with today. That hasn't moved up. And that's in favor of the utilities, but it keeps the sellers from wanting a very significant portion of base price at this time. Now, if your production costs are $40 and you're signing a base price or a contract with a base price element that's 68 today, or I think the next contract set that has a new base price is going to be higher than that. It just hasn't come into the market and been reported yet. So let's just say 70 or 75, because we can't have such disparity between term and spot. But if your price is 40 or your cost is 40 and your getting a base price of 75 and a market component as well, that's a good contract for a junior producer.
Right. And I'm kind of wondering about the psychology, but I've talked about that a lot this week with regards to, the buyer's market, the seller's market. Yeah, and the psychology on both sides there. So I appreciate what you say about how it used to be for new producers. £200, £200,000 here, £200,000 there. Makes sense because we don't know if they're good enough. But at the same time, as utility, I'm able to go and buy it in the market wherever I want. So I'm in no kind of rush for this to kind of tie myself down back then. Now, I just wonder if you've got a handful of new producers, not a lot of choice. Maybe you do want to tie the amount of pounds you can get out of them down a little bit more. Maybe those numbers do increase, right? Because I may not have other choices, once this company's proved itself. By then I've run out, right? So the psychology, I think, is kind of interesting, and the sellers likewise. If you've kind of got these hybrid contract terms where you can agree higher base levels and align the ceilings much closer to spot as part of your hedging, that's great. You probably would want to do that. I don't think anyone's going to make the same mistake of saying where we're 100% exposed to spot. We saw it happen the last cycle. I think things can go wrong or have gone wrong. So how do you kind of read that psychology? You've obviously got a few contracts already in place. You will be, with new pounds coming through, be talking more term contracts. How do you view it now? Are you sort of more in control than you were, say, the last 5 years?
Yeah. Well, risk management for the utilities is still risk management for the utilities. They'd like to get their supply from multiple sources. Unless you're a one reactor utility or a one unit shop, you probably spend some time and get material from multiple sources. And that means that's why, the juniors, the higher risk profile guys who, the ones who haven't yet performed, get smaller contracts. That being said, I think you're right. There is some psychology that, the market is thin and they're not getting opportunities to take 500,000 pounds or £1 million a year chunks from the majors, the big producers. Therefore, you have to take bigger pieces from your new contracts. So I think the size of the annual contract for the up and coming producers, is moving upward. And that's because of the lack of participants on the sales side. And we've seen that, utilities have gone out for contracts and it's been reported back. They didn't have as many responses as they expected. But again, that's because, who's got the pounds?
Well, who's got the pounds? And even if you do, maybe I'll wait 3 months and see this thing's at 150. I'll negotiate from that position. Maybe there's a bit of that.
Yeah, well, plenty of it. And, there's producers, coming to the market who are completely unhedged, just fully on the bet that the spot market is going to be the place and that they'll be able to put all of their production in the spot market at very good prices.
Maybe they will in the short term. It'll be interesting to see how that plays out. Do you ever see a situation, because I want to make this sort of North American focus, we've had some great commentary from around the world, but from a North American perspective, and I'm sure conversations that you're exposed to, if life does get difficult, as a utility, do you start leaning on government and saying, well, hang on a sec, don't you think that these American producers should be selling into American companies only? Should we be exporting uranium? We're kind of creating a real problem for ourselves here, boys. And we know lobbyists and, how it all works and in other sectors and so forth. Do you ever sort of see a scenario like that? And if so, does it hinder you?
That would be quite something. That would be a real turn of the cards. Just a few years back, the uranium producers of America were telling the utilities that they should be buying U.S. And saying this would be good policy, and lobbying the government that the U.S. utilities should be buying a larger portion of the U.S. production. So, and that was quite well resisted because there's, the U.S. producers were simply producing zero at the moment. And this was all about getting contracts and incentives to produce, but not, to turn the cards and flip it over completely and say now the utilities would come back, Matt, and say, well, the U.S. producers should only sell to the U.S. utilities. I'd love to see that. That would put a big smile on my face.
When I said front row seats, for sure. But it's not. You look at other sectors where that has happened, other industrial sectors where that kind of has happened, right? You made in the U.S. of A.
Don't get me wrong. The U.S. producers, love to do business in the United States. It's the right place, and we have a good market. The utilities are, the utilities do business with the U.S. producers. We have contracts at Peninsula, for are with U.S. utilities and European utilities. So we're happy to be doing business here in North America where we produce the pounds. It's easiest for us. We don't have the transportation logistics issues that of shipping to other places. But a lot of uranium gets traded here in North America, whether or not you're doing business with a European utility.
I mean, so when we obviously last spoke, you talked about, so you had to kind of deal with kind of curveball thrown at you earlier, in the middle of last year, and you're sort of now quite close to production. Now, in a price environment like this, obviously you've got fixed contracts there, but in a price environment like that will kind of do something for you. It's not a case of, money covers a multitude of sins. It's a case of it makes up for the unexpected in some ways. So are you looking at the market like that and going, well, actually, I think we're going to be in a position to kind of play catch up just a little bit quicker now, unexpectedly?
Well, capitalizing our ambitions is a lot easier in this market. Absolutely. It's good to work with tailwinds, a good uranium market. Like you said, we had to press reset and go towards expanding the capability and the capacity of our plant, and especially the back end of the plant, so that we can produce a final dry yellow cake. That plant construction takes a little bit of time and money. We've addressed as a company the money picture and raise the capital we need to construct that plant and put the project into production. We're happy about that. Any other, additional expansions, which, now there's more pressure to say, why are you building a 2 million pound a year plant when you could build 3 under your license? The question is, where do you get that next million from? And that too takes money. You have to put drill rigs to work. You have to, build a satellite plant or something like that. But now the pressure is, how far can you go? How high can you ramp up? For us, it was just August of last year when we reset our ambitions from 800,000 pounds a year to 2 million or thereabouts, and the market, in the interim has really moved upwards. I chuckle because in our August, the life of mine study, we did a sensitivity of the price of uranium, and the sensitivity graph that we prepared, and it's in our corporate presentation, stopped at $100 a pound. It was still so far away in August. So, the world has changed, now the expectations and the questions are how far can you go and how much can you build your production profile in the short term. So, people are trying to get into production, and it's going to take years. It's a lot of work. You need a really good team. Peninsula has an excellent team, producers, experienced operators. We have, in my view, a team that lets me sleep well at night, knowing that the work gets done and the project moves forward on schedule.
You raise an interesting point there, actually, Wayne. I kind of feel like there's 2 conversations that go on in this market. There's the reality, and then there's the expectation, right? So and by that I mean companies that can do and they kind of get on with it. I'm going to throw you in that camp, right? Where Peninsula, you've had a few rough moments with the markets, etc. Everyone has, and some of it their own doing, and some of it unexpected. But you're in that camp of the real world. So you get this thing into production, and there's no let's say BS around what the process looks like. It's mining's tough. It's really hard. It's even tough when you actually got to get into production and actually produce that revenue and grow, still tell a growth story, right? And then there's the kind of expectations space, which is obviously around, exploration, and there's the good and the bad and the ugly in there. And then there are other developers too who are perhaps more concerned with the marketing and the storytelling than the doing. And I kind of feel these things are running in parallel. But as Dustin Gary said to me earlier in the week, he said, like, the rubber's got to hit the road at some point. If you're able to get into production, you've got to show that you're going to get into production. Not talk about it. Show how you're going to get into production as it is the best that company can, because all the marketing dollars in the world won't do that for you. It's actually the people who are going to do that for you. It's the knowing the step process to kind of get that over the line and into production. That's the only way this thing happens. So real world versus slight fantasy in some cases, but slower moving projects which perhaps don't have the right people in charge for things other than marketing. And it's kind of confusing as an investor. So I think I want a blended approach to my uranium investments. I want a bit of exploration, don't mind that, a bit of early development, late development, and even some of the producers. And I also like some of the ETFs, and I kind of like the split thing as well. The deep yellow, whatever, or yellow cake, whatever you're into. Get that balance right. But do you know what I mean about that kind of? I mean, you must have looked out there and go, well, that's a little bit speculative, right?
Well, thanks, Matt. If I was an investor, and I was thinking that I want to put some money into an up and coming uranium producer, my recommendation is look for companies that have done their de-risking and been very public with their disclosures. Do you have a resource statement that's in a 43101 or a JORC or an SK format that the investor can review to have confidence that your resource has been reviewed by a third party and that you're putting a mine on a good resource? Do you have a up-to-date feasibility study, a life of mine economics that, not something, and then is the company presenting a production profile, a ramp up plan, how much production do you expect? Believe it or not, some companies out there right now are saying we're going into production without actually saying how much they're going to produce. They want the investor to make the assumption and make the assumption favorably for them and put their money into it. So there's fundamentals. There's companies that push fundamentals and do the right thing and have done the de-risking and are technically adept and have the operational team that know what they're doing. And then there's some companies, like you said, more on the promotional side that again want the investor to make the assumptions rather than to fill in the blanks with actual data.
Yeah, and who am I to say one's right or one's wrong? If the share price is moving, you got happy shareholders, but at some point, I think you got to work out the balance of your portfolio between that kind of in terms of the risk profile. So exploration clearly going to be higher risk, but higher return if it comes off and you enter and exit at the right points. Development a little bit safer, but again, those development companies need to kind of get to an end point, which is, I think this thing's going to get into a FID stage. It's going to be able to get financed. And maybe get into production. Now, there are no guarantees just because they've got the money, it'll get into production either,
We know that a rising tide lifts all boats, and we certainly have a rising tide in the uranium market. So everybody is going to enjoy, if you're an upcoming uranium producer and want to be even an explorer, this is a great time to be in the uranium space. I think that's how we opened. And so the investors have an opportunity and to look at producers, developers, good marketers, explorers. I think they're all class of uranium company. And now welcome everybody new. I mean, there's, uranium companies and companies that have never been uranium companies that want to put uranium projects on, because this is the commodity at the moment. This is, I come from a conference last weekend and was introduced to a whole bunch of people who say, do you have a project to spin out? I'd love to get a uranium project to develop. We're gonna go back towards a couple hundred uranium investment opportunities, and if that's your investment style, there's going to be opportunities to put down new money into companies that have never touched uranium.
Yeah, and good luck with that, because I'm sure people spin out their good stuff, right?
All the best. Yes,
all the best. You're welcome. But yeah, there's the games to be played there. But if you know what you're getting into, then I guess it's fine there. But it kind of raises an interesting point, which is maybe some people looking and going, this thing's a bit toppy. I've missed the boat. It's floating, but I've missed it. Do you think that's right, or do you think people can still make money at these levels?
There's plenty. I don't think you missed the boat. I think the price is still moving upward. The uranium market is a market. It's going to go up in chunks, and it's going to stabilize. It might retreat a little bit. But in the end, the trajectory in the last several months has been upward, and I have seen nothing to change that trajectory.
Yeah, I guess what I'm looking at is uranium can do no wrong. May not necessarily be the best strategy. So data point for your investing. There's a lot of good stuff out there. There's a lot of rubbish out there, and there's a lot of rubbish coming down the line as well. So I think, come back to people, just think about your strategy for including uranium in your investment portfolio. Blended approach, please. Match your risk profile to your choices, and of course, doesn't have to be just uranium in there either. I think.
I think too, though, that if you look at the equities, the stocks of the producers and developers, they've lagged the physical price of uranium, in increasing. So there's, if you're concerned that the price of uranium might not be going up, because it's already there, you still have a lot of time, I think, to attach to a producer, a developer, and see the market respond to higher prices, because there are companies, and Peninsula is one of them, that has not increased with the price of uranium. As we were going through the process of getting all the information and the money that we needed into the market over the last 6 months, coming into 2024, I feel very good about where we're positioned. We've done a capital raise. We have a lot of opportunities to share good news into the market and to stimulate our share price with some good actions. And positive results from the work that we're doing. There's companies, if you look, that are still a very good value in the market, and investors should take their own deep dive and do their own research. But they'll see them. They'll see the companies that haven't performed with the market, and they'll see the ones that are really poised now to move, rather than, a little while ago when the market was moving.
Never a truer word. Well, thanks for that romp through your thoughts on the market at the moment. People trying to work out what's going on. I was listening to John Champagne of Spur yesterday, and he was talking about the fact that you've got a lot of the generalists from the banking, from institutional side, even brokers, who are saying, well, what is this uranium thing that it seems to be the only thing green on any charts at the moment? And 250 is a lot of people over the last, I think he said 3 weeks. There's a lot of people to be kind of leaning in and going, what do I need to know? How do I understand how I play this? And then start either recommending to clients that they deploy capital, or start deploying capital themselves as funds. So it feels like there's a wall of money looking at the space, and hopefully one or two of them start sort of picking up the opportunities ahead of them. They'll have to make the same sort of choices we've talked about today in terms of, what is good and what is betting. So Appreciate time today, Wayne. Really, thank you.
I appreciate it. Matt, I think, just again, finally on the U.S. perspective, for me, it's really exciting to see a number of companies in the United States who have idled their projects in the past, now bringing them back into production. Uh, Investors are going to have an opportunity to look at U.S. producers again and make their bets, place their bets. So look at operating teams, look at past performance, look at the project quality, the scale. Are you making a long-term bet or a short-term bet? But for me, it's really exciting to see the revitalization of the U.S. industry. The biggest names, the ones who have past operating projects, generally speaking, are restarting their projects. The market's right, and this is a good opportunity to get in on the front end of up and coming producers. Watch the development. The 6 months, 8 months prior to the restart of production tend to be really good for shares and share price. And so, you have some opportunities this year to look at the juniors, the up and coming producers, place a little bit, put some money in on the big boys too, because they don't fail to go up with the market. So, it's a good time.
It's a good time.
Thanks, Matt, for the opportunity to chat with you again. It's nice, and I wish you well.